Cars are incredibly expensive, and the average car buyer is spending an astronomical amount financing either a used or a new car. And as a result, the average American who has purchased a car in recent years is in a lot of debt. And today, with rising interest rates, this isn't great. And in recent weeks, Experian released their quarterly report for Q1 of 2023, breaking down all things automotive financing for new and used cars. This gives us some really great insight into where the car market is heading, what this means for banks and financing institutions, and most importantly, what this means for you, the car buyer. And so in today's video, we're going to be breaking down this report, and I'm going to be talking about what this means for somebody who's looking to buy a car in the near future. So let's get started. Now, I do want to preface that this is Q1 of 2023 data, so this is a few months old. And I know that as I sit here today recording this video, we are just a matter of weeks away from Q3 of 2023, which is crazy to think about. The reason why we're reviewing Q1 data as we're just weeks away from Q3 is because while most companies release their Q1 data at some time in April, just a few weeks after Q1 ends, Experian takes a lot longer to report their findings. So while the data may seem outdated, it is actually the most up-to-date information that we have. So let's dig in by getting started off with new car vehicle financing data. Here you can see the breakdown of new vehicle financing by segment, and you can see that SUV and wagon makes up the majority of new financed vehicles. And over the last year, financing for this segment has actually increased, while financing for vehicles like coupes, hatchbacks, and pickup trucks have decreased slightly. You can see that the average credit score, either leasing or financing a new car, has increased as well. In fact, this has been on a steady rise since 2018, with the average score going from 718 in 2018 to 733 in 2023. Now, truthfully, I was a bit surprised to see that the average credit score of a borrower for a new car is rising over the years, because I would have thought that given the fact that in 2020 and 2021, it was relatively easy to borrow money and more people had expendable income than they normally do, I would have thought that we would have seen the average credit score of the average new car buyer actually dip down in 2020 and 2021, but that actually wasn't the case at all. This is something that doesn't mean a ton to us today, but it is something that's interesting to note. Now, as far as the average credit score for the new car buyer today, it is definitely on the rise given the fact that it is simply harder to borrow money than it once was. New cars are very expensive, they come with high interest rates, and banks in general are becoming more strict with who they lend money out to. And so as a result, if you are somebody who's wanting to borrow money to buy a new car, you're going to have a better credit score than you once did. You can see a breakdown of borrowers here. Remember, deep subprime is the worst level of borrower. This is someone with poor credit scores, history, and credit worthiness, while a super prime borrower is on the opposite end of the spectrum, and this is someone with a great score, a great history, and great credit worthiness. Deep subprime borrowers made up less than 0.25% of all borrowers, and super prime increased from 29.31% in Q1 of 2022 to 32.49% in Q1 of 2023. So 32.49% of all borrowers this past first quarter are super prime borrowers, so people with excellent credit. All other segments decreased as a result. You can see prime went from being a little more than half to a little less than half of all borrowers, and near prime and subprime decreased as well. Even with car prices going down, the amount financed has actually increased from $39,638 to $40,851, with the average monthly car payment now sitting at $725 per month. And the reason why we've seen this increase year over year is due to the incredibly high interest rates, which are plaguing the car market as a whole, really plaguing any industry that has to do with financing. In 2021, the average rate for a new car was 4.15%. In 2022, this rate was 4.1%. And in 2023, this has skyrocketed to 6.58%, while the average loan term has stayed pretty consistent. A 6.5% interest rate on a new car is insane. But just wait until we dive into used cars. Monthly payments and loan amounts increased across all borrower segments, as you can see here. But the good news is that we are seeing the rate of increase beginning to decline. And what I mean by this is that over the last couple of years, from 2020 to 2021 and 2021 to 2022, the cost of a car and the average monthly car payment have skyrocketed disproportionately compared to historical years. While in present day, from 2022 to 2023, those increases aren't quite as sharp. We are still seeing an increase across the board, but it's not as high, at least not in relation to what we've seen in previous years. Interest rates, of course, is the one exception, which we've seen skyrocket between 2022 and 2023, but this was, of course, expected given the fact that interest rates on a federal level have been rising as well. And I do expect that as the Federal Reserve begins to either taper interest rates or level them off, we will begin to see a bit of a reprieve with the car market as well. But only time will tell. And so while new car data isn't good news by any means, we are still seeing record high monthly car payments, record high financing amounts. We are beginning to see this increase taper off a little bit, and we aren't seeing the incredibly high increases that we saw previously. But now let's head on to used cars. Subprime auto loans are near record lows, and this has been steadily decreasing over the last few years. You can see that subprime borrowers made up 7.07% of all borrowers for used cars in 2018, and today they make up only 3.06%, down about 0.5% from this time last year. At the same time, prime borrowers are increasing. You can see in 2022, prime borrowers made up 40.97% of all borrowers. Today, that figure is 42.41%. Now, unlike new cars, where the average amount financed has actually increased over the last year, for used cars, the average amount financed has decreased, but the interest rate on these used cars has skyrocketed. The average amount financed in 2023 was $26,420 for used cars. This is down from $28,010 in Q1 of 2022. This again overall matches what we're seeing in the car market. Used car prices are slowly but surely going down, and there certainly is more negotiating power at dealerships as well. But interest rates are at an astronomical high of 11.17%, which is crazy high. In fact, the other day I was scrolling through Facebook and I saw an ad pop up for a local Cadillac dealership, and the ad was advertising a 6.5% interest rate for new cars. And I remember turning to my husband and saying, man, whenever a new car dealership is advertising a 6.5% APR as a selling point, you know the interest rates are out of this world. It doesn't feel that long ago whenever dealerships were advertising a 0% interest rate, and now 6.5% is considered a selling point. It is crazy. And the fact that the average interest rate for a used car today is 11.7%, that is the average across all borrowers, is absolutely insane. Please, I am begging you, do not ever buy a car with an interest rate of 11.7%. It is simply not worth it, and it never will be. The average monthly car payment in Q1 of 2023 is higher than it was in 2022 and currently sits at $516 per month. This is again due to the fact that interest rates are higher, and as a result, monthly car payments are high as well. Loan terms for used cars are pretty flat year over year. People are financing less for used cars, but they are paying more because of these high rates, as you can see here. But of this entire Experian presentation, the thing that is most mind-blowing to me is whenever we break down interest rates across borrowers for used cars, because this is where things get really out of hand. The average rate for a super prime borrower, so somebody with excellent credit, is 6.79%. Prime borrowers are paying a bit higher at an 8.75%. Near prime is pretty dang high at 13.28%. Subprime is getting into credit card level territory at 18.55%. But deep subprime is paying 21.32% in interest. Now, let's take a moment to do the math on this one. The average deep subprime borrower is financing $19,162 for their used car, and they're financing that in a term of 67 months. In this scenario, you are paying $32,929.06 for a $19,000 car. You are paying $13,767 in interest payments alone. You are paying 73% of the total car's price in just interest, which means that once you pay off that loan, you would have paid off 173% of the total value of that car. You could have not only purchased that car in cash for that amount, but you also could have bought a second, slightly less nice car for the amount that you paid in interest. And that is why if you are somebody that has less than great credit score, you should absolutely not buy a used car in this current market. It is well worth it to simply buy a cash car, even if you don't plan on keeping that cash car forever, buying something that will get you by for the time being, save up for a car and buy one whenever interest rates are lower. 21% for a deep subprime borrower to buy a used car is just incredibly incredibly crazy, and it's something that can very literally ruin your financial future if you get sucked into this trap. This is wherever you have these people that pay these insane car payments for extremely mediocre, cheap cars. Overall loan balances grew by 8.4% year over year. While the amount of subprime borrowers borrowing money in 2023 declined, the amount of loans owned by subprime borrowers actually increased. 30-day delinquencies are rising from 1.6% in 2022 to 1.89% in 2023, and 60-day delinquencies have also risen. 60-day delinquencies are at a 4-year high, while 30-day delinquencies are nearing 4-year highs. Used cars are also going delinquent at a much higher rate than used, and delinquencies are coming from independent dealerships much more frequently than they're coming from franchise dealerships, which is a testament to the type of customers that are going to these different types of dealerships. If you're somebody with good credit, you can get normal bank financing. Typically, you're going to go to a franchise dealership. While if you are somebody that has poor credit, you can't get financing through a traditional bank, then that's whenever you go to these independent dealerships that are a lot more predatory. One thing that I do want to note whenever it comes to delinquencies is that a loan is much more likely to go delinquent if it's between 0 and 3 years old. That doesn't necessarily mean that the car is 0 to 3 years old. It means that the origination of that loan happened within the last 3 years. So most loans that go delinquent are loans that have been taken out within this 3-year period of time. And the reason why this is interesting in the context of this Experian report is because though subprime borrowers are borrowing money less frequently today than they have been in previous years, they are still holding a multi-point percentage of all outstanding loans, over 3%, which means that these loans are more likely to go in delinquent than all of the other loans that are out there. And like I've said in a number of my videos in the past, you don't need all of the loans held by banks to go delinquent to really hurt financial institutions. You don't even have to have a majority. All you have to have is a small portion to really throw off the equilibrium of the financial institution, and it puts these banks in a really tough spot. This is something that I have been growing increasingly more and more concerned about, given the fact that cars are still very expensive, the cost of living is rising, people are taking on an insane amount of consumer debt, and student loan forgiveness is coming to an end, which means those payments are going to kick back up very, very soon. I think all of these factors are really spelling out trouble when it comes to these delinquent loans, and I think that this could cause some major problems later on. People are paying too much in interest for new and used cars, they're borrowing far too much money, and in general, these cars are still too expensive. And it'll be really interesting to see how the rest of 2023 ends up playing out. But like always, you guys, I would love to hear your thoughts. If you have any questions, comments, if you have anything to add, I would love to hear it. So make sure to leave a comment down below. And while you guys are at it, make sure to hit the like button, hit the subscribe button, and hit the notification bell. And I will see you guys in the next video.